Hey everyone, welcome to another homework help video on Hatling EDU. Today we're going to be going over Chapter 9 homework as a part of the Financial Accounting Cengage course, and we're going to go over a number of transactions for fixed assets, including the sale of the asset, including the final sale of the asset. So the following transactions and adjusting entries were completed by Legacy Furniture Company during a 3-year period. All are related to the use of delivery equipment. The double declining balance method of depreciation is used. In year 1, we buy the truck, we have some repairs, depreciation is recorded. And then in year 2, we purchase another truck, sell the used truck, and pay a garage for some repairs and maintenance, record depreciation for the new truck. In year 3, we purchase a new truck, sold a truck purchased in January 6th of year 2, and then we record depreciation on the remaining truck when we estimate the useful life, and then we're journaling each of these transactions. We have our chart of accounts, and we have our general journal. So our first entry is to record the purchase of the truck. And we purchased the truck for January 1st or January 4th. In our chart of accounts, we have delivery truck is our asset. So we debit delivery truck and we purchased it in cash. So we're going to credit cash. For repairs to the truck, we need to expense these. These are not capitalized expenses, right? These need to be recorded in the current period because it's to keep the truck in use really only during the current period. We're going to have more maintenance next year. And so our expense is truck repair and maintenance expense. Then at the end of the year, we have an adjusting entry for the amount of depreciation taken during the year. And since we bought it in the first half of January, we're going to assume it was bought on January 1st. And the estimated useful life of the truck is 4 years with a residual value of $2,000. We're using the double declining balance of depreciation. And under the double declining balance method, we need to calculate our per year percentage rate, which is 1 divided by 4 is 20.25 or 25% per year. And under the double declining balance method, we need to multiply that by 2, and that's 50% depreciation per year. And that's on the net book value of the asset. We're not taking salvage value into account until we reach the salvage value or the residual value. And that's because if we multiply 0.5 by the depreciable base of the asset, we'll never actually reach the fully depreciated value of $2,000. And if the residual value was 0, we would never reach 0 under this method, because if we are always dividing, right, a non-zero number by 2, we're never going to reach 0, mathematically speaking. So there's just some background for you there, but that's why we're not use it. That's a good way to remember why we multiply the net book value by 50% and not the ending value, or not the depreciable base, as we would in the straight line method. And so 50% of 32,000 is 16,000. And in our chart of accounts, depreciation expense delivery truck is what we're going to use. And accumulated depreciation delivery truck. You can see our first year is correct. Oh, I forgot the dates. Perfect. Always make sure to check your work, guys. You don't don't submit incomplete answers. It's leaving points on the table. Um, for question two, or year two, I should say, we purchased a new truck for $80,000 in cash. So we'll record the purchase of the new truck. And it is correct. We debit the same account for delivery truck, but in the fixed asset subledger, it will show as a separate delivery truck. And on April 1st, we sell the used truck for $16,000 in cash, but we have to record the depreciation year to date first before we sell it so that we can calculate the gain and loss needed on the asset, on the sale of the asset. So we need to record our depreciation expense. And we're using the double declining balance method, and we need to calculate the net book value at the beginning of the year. And our depreciation last year was $16,000. And so our depreciation this year, right, our net book value is 32,000 minus 16,000. Now we use our double declining balance rate that we calculated last time of 50%. The full year would have been $8,000. However, we only had 3 months of the year, which is, so if we divide by 12, multiply by 3, we get $2,000. That's our year to date partial year depreciation on this truck. Also on April 1st, we have an entry we have to record. Now we have to record the sale. And when we sell the asset, we have to debit the accumulated depreciation because we're reducing that to 0 for this asset. And our total accumulated depreciation is 2,000 plus 16,000, so $18,000. We have to record the debit to cash that we received, and we received 16,000 in cash. And then we have to credit the the purchase price or the historical cost of the delivery truck because that was on our books at historical cost, so $32,000. And the remaining amount is the gain or loss here. And as you can see, we have 34,000 in debits and only 32,000 in credits. So we need to credit our gain because we got more our on the balance sheet, the net book value was $14,000 on the date of the sale. We sold it for 16,000, we have a gain. And that's going to be in the revenue section here, gain on sale of delivery truck. And it looks like we have to attempt this entire problem before we can check our work. And then for June 11th, we paid a garage $310 for miscellaneous repairs to the truck. And that's going to be another repairs and maintenance expense entry. And then at the end of the year, we need to record the depreciation on the remaining truck. So December 31st, we purchased this new truck for $80,000. We had a residual value of $7,000 and an estimated life of 5 years. We're using the double declining balance method because that's our method for all of our trucks. And what it does is it front loads the depreciation expense into the first year or into the first few years. Our yearly percentage under the straight line method is 0.2 or 20%. Under the double declining method, it's 40%. And again, we purchased this new truck in January 6th, which is in the um, it's the first half of January. So we're assuming that it was purchased for all of January. For depreciation purposes, we're going to do 12 months, so full year. So we take $80,000 times 40%, and we get 32,000 in depreciation expense. Perfect. So we had 32,000 in depreciation expense this year. And then in year 4, or year 3, I mean, we purchased another new truck for $85,000. And we're going to record that July 1st, delivery truck debit of $85,000, credit to cash. October 2nd, we sell the truck purchased January 6th, year 2 for $18,250. First, we have to record the year 3 depreciation for the truck. And our net book value at the beginning of the year is $80,000 minus 32,000 in accumulated depreciation. This is our net book value at the beginning of the year. We have to multiply it by our rate of 40%. $19,200 would be our depreciation for the full year, but we're not depreciating it for the full year. We're only depreciating it for the first 9 months of the year because this was sold on October 2nd, which is in the first half of October. So we're assuming that September 30th it was sold. That's 9 full months of depreciation. So we're going to divide it by 12 to get our monthly rate of 1,600 times 9 months is 14,400 in depreciation expense. And then we're going to record the sale of the truck. And so we need to credit our accumulated depreciation for 14,000 plus the 32,000 from year 1. And that's 46,400. And we also have to debit our cash because we received cash for the sale of 18,250. And we'll wait to see if we have a gain or loss first before entering gain or loss. And then we have to credit delivery truck. And always make sure that the debits have to be in the top part of the entry. So if we had a loss, that's going to be a debit. We couldn't put that below delivery truck because delivery truck is a credit. Our debits have to be above our credits, right? And they're indented to the left, credits to the right. Debits to the left, credits to the right. And our initial cost of this asset was 80,000. And our difference here, 80,000 minus 46,400. Our net book value before selling was 33,600. We only sold it for 18,250, and so we had a loss on the sale of 15,350. Oof. It's quite the loss for them. And we have to record that as a loss. Chart of accounts, the loss appears in the expense section. Loss on sale of delivery truck. And that's going to be a debit because our losses are debits. They reduce our owner's equity. And on December 31st, we have to do an adjusting entry for the depreciation on the new truck, the only remaining truck, the $85,000 truck purchased on July 1st. So that's a mid-year, only 6 months of depreciation, useful life of 8 years. So we take 1 divided by 8 is 12.5% times 2 is 25% per year times $85,000. That's our full year amount. However, we are only doing 6 out of 12 months. And so 10,625, that's our final year depreciation expense for this asset. That's our first year depreciation for this asset. And there we go. And that's all for this question. Thanks, everybody. If you found this helpful, make sure to like and subscribe. And good luck with your homework. I hope you guys learned something about the journal entries necessary for buying and selling fixed assets. Thanks.